Welcome back guys to another zero DTE video, and today Ernie's going to be talking about the impact volatility has on zero DTE, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's course. Enjoy guys.
We're not really subject to that volatility crush that much, if at all. What we do is a butterfly that's way out of the money, very tiny risk, large potential profit, and we're hoping to stay into the trade for as long as it takes. If price moves very quickly to our strategy, we can make a lot of money very quickly, but we never have enough risk to ever really even worry about it. As a matter of fact, our risk is defined by the strategy itself. We don't really pay much attention to it. As a matter of fact, I don't manage the risk at all. You make the risk small enough so that you don't have to manage it. So all you're really doing is profit management. There's virtually no anxiety in this trade, and the positive expectancy is much higher, and it's scalable where the other trades are not scalable because of the inordinate amount of margin that you have to put up in order to get much larger wins. With our strategy, you can just increase your risk just a little bit to make the potential win much, much larger. So that's why we trade this. Low anxiety, very little drawdown, positive expectancy in the long run, just overall a much better trade. Now, that's great with all things being equal, but things change over time. And as you know, right now, things are changing. Volatility, it has generally come way, way down, where most of 2023, volatility was sitting above 20 and as high as 24, 25, as high as 27. And then prior to that was even higher, above 30 for some periods of time. But recently, in the latter parts of the 2023, volatility has come down dramatically, way, way down. In fact, it got so low that it was at least 3 years prior to it before we had seen volatility that low. Now, when volatility is in that range, that really low range, it changes the dynamics of all of your trades. First of all, with the Jim Olsen fly and the Iron Condor fly, puts you in a position where it's much more difficult to get that amount of premium that you're looking for because this lower volatility, remember I said they are vega negative, in other words, when volatility is very low, a lot of that premium decay that happens over the course of a week gets accelerated, particularly in the first part of the day. So they're left with much smaller potential profit to go after, and they're hoping even more so for that volatility crush to happen, and it makes it for an even more difficult trade. Now, from our point of view, it doesn't affect us at all. It just changes the dynamics of the trade to some degree and how we would approach that trade. Now, typically when we have higher levels of volatility, that means that we can put on much wider flies and push them further out of the money and take relatively the same amount of risk that we would always take. And that is because of the higher volatility that suppresses premium decay. And so it gives us even more potential profit within our strategies. But our risk that we approach the trade with never changes. It's always super small. But we can actually go after much larger potential trades. When volatility is super low, the premium or the value of those flies that we put on are preloaded with decay, right? In the first part of the day, they become already bulbous. All right, so with volatility super low, our butterflies become advanced in terms of the premium decay. So the first part of the day, they've already decayed almost to their full amount. And that only lasts really for the first half of the day. Like I said, regardless of whether we have low volatility or high volatility, that effective volatility really is only the first part of that day. Once you get to about 1 o'clock or so, 2 o'clock, volatility, no matter whether it's high or low, it ends up being about the same from about 1:30, 2 o'clock on to the end of the day. That part of the day never changes. But we'd like to get into trades and get out very quickly if we can. So what we can do is we find that this advancement of premium decay will affect the narrower width flies even more. So the way we adjust to all of this change in volatility is pretty simple. When we have high volatility, we can make much wider flies, push them further out of the money. With low volatility regimes, we use narrower flies and then bring them closer into the money. And so they already have some level of premium decay into it. And so if price moves into it, we have quick profits. Still taking very little risk and then going for that large outsized asymmetric return.
Thanks for watching guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks guys.